So today we have 3 questions from our members that we're going to discuss. Firstly, what is depreciation? Secondly, does the bookkeeper prepare the depreciation schedule? And finally, what happens when you dispose or sell a depreciable asset? Now, before we get too technical, let's consider this very simple example. Let's say our business purchases a machine. Is this an expense? What do you think? No, it's not. When you buy a machine, a car, furniture, land, or buildings, we do something called capitalization. It goes into the balance sheet. So why do we capitalize the machine? The machine will help our business generate revenue over many years, and therefore we will slowly expense the machine over time. Now that's called depreciation, and clearly depreciation will affect our accounting profit. So let's look at Chapter 7 of the Australian Master Bookkeeper's Guide. So all non-current assets are deemed to provide future economic benefits. What's that? Well, they contribute directly or indirectly to the cash flow of the business over time. Just like our machine in the previous example. Eventually, the machine may stop working or become too old. Therefore, we say it has a limited useful life. So when we account for depreciation, we consider the decline in the future economic benefits of our machine through things like usage, wear and tear, and maybe eventually one day our machine is obsolete. Now, we record depreciation, but this is not the same as the current market value. Depreciation commences when the asset is available for use, and that's usually when it is in the location and condition ready to start operations. And as we just discussed, this machine is going to help us generate revenue over many years. So therefore the cost of the machine will be expensed over several accounting periods, and that is the process of depreciation. For more reading, go to the accounting standard AASB 116. So we have something called a depreciation schedule. Here we have an example of a machine which costs $33,000. This is an estimate of the use of our asset, or the machine in our case, over time. It shows the depreciation calculations each year. But who prepares this schedule? In some cases, the accountant or tax agent is responsible for calculating the depreciation. They'll calculate the depreciation and advise the bookkeeper of the expense. The bookkeeper will then record this in the management accounts. Now, when we calculate depreciation, we need to know something called the useful life of the asset. Now, this is a difficult thing to calculate. It's difficult for bookkeepers, accountants, or even business owners to determine. So to assist, the Commissioner of Taxation has published his own determination of effective lives of depreciable assets. We have a link in the description below. So, as bookkeepers and accountants in Australia, we tend to use these values set out by the Commissioner of Taxation. We use his estimate of the useful life. When a depreciable asset is sold, the first step is to record depreciation up to the date of sale. This will determine the asset's carrying amount as at the date of disposal. The sale or disposal of the asset will give rise to a gain or maybe a loss on sale. If an asset is sold for more than its carrying amount, a gain on sale will result. The gain on sale is recorded as other income in the profit and loss statement. Otherwise, if the asset is sold for a loss, That means it sold for less than its carrying amount. The loss on sale is shown as an expense in the profit and loss statement. If the client is registered for GST, then we must remit to the Australian Tax Office the GST that's applicable for this transaction. The GST is 1/11th of the sale proceeds. Have a look in the description below for further examples and journal entries.